Hello and welcome to the Upgrade the World podcast. I'm your host Josh, and for episode 25, I wanted to talk about the technology that inspired me to make this podcast, Bitcoin. Since the Federal Reserve was founded 110 years ago, the US dollar has lost over 97% of its value. This is due to inflation caused by printing more dollars. Throughout history, the allure of printing money from thin air has proven too seductive for humans to resist. Overprinting money has caused fiat currency failures in China, France, the Soviet Union, Germany, Zimbabwe, Venezuela, Peru, Hungary, Greece, and many other countries. Every single fiat currency in history has eventually failed. In fact, the average lifespan of a fiat currency is about 35 years. In 1971, President Nixon severed the US dollar's convertibility to gold, which puts the US dollar in its current fiat form at 52 years old. In that same year, the US national debt was $398 billion. Today, the nation's debt is about $33 trillion. Today, interest payments on the national debt are $88.9 billion, which is more than the US spends on national defense. Over time, as the national debt continually increased, the devaluation of the dollar created advantageous terms with respect to paying off a fixed debt amount with future devalued dollars. Ultimately, U.S. citizens are forced to invest our money or watch our wealth be siphoned away through the silent tax of inflation. One of the key principles of Bitcoin is there will only ever be 21 million Bitcoin, which makes Bitcoin a deflationary asset. This limited supply mimics the scarcity characteristics of precious metals like gold. However, since Bitcoin is digital and can be stored in a digital wallet, it is highly portable compared to physical assets like gold. Users can store significant value on a small hardware wallet. Bitcoin is special compared to other cryptocurrencies because it is the only truly decentralized cryptocurrency. Bitcoin operates on a decentralized network of nodes, meaning it is not controlled by any single entity, government, or organization. This decentralization reduces the risk of manipulation or interference and also makes the task of stopping Bitcoin impossible. This decentralization and the ability to digitally store value allow you to become your own bank. You can store your wealth without counterparty risk. Bitcoin can be accessed and transferred globally 24/7 without the need for intermediaries. This accessibility is particularly attractive in a world where traditional financial systems can be slow and cumbersome for cross-border transactions. Bitcoin transactions are recorded on the blockchain, a public ledger, providing transparency and immutability. Once a transaction is confirmed, it cannot be altered, enhancing security and trust. The Bitcoin network relies on robust cryptographic algorithms and consensus mechanisms like proof of work to secure transactions, making it resistant to censorship and fraud. Approximately every 4 years, the reward for Bitcoin miners is halved. This event, known as the halving, reduces the rate at which new Bitcoin are created. The next halving will occur sometime in April 2024. Over time, Bitcoin has gained recognition as digital gold or a store of value akin to precious metals. This narrative has attracted institutional and retail investors seeking an alternative asset class for diversification. In episodes 15 and 19, I discussed the companies like BlackRock, ARK Investments, and Grayscale Investments who have spot Bitcoin ETF applications being actively reviewed by the SEC. Inside sources have claimed the SEC has set a December 29th deadline for final updates to company filings to ensure their spot in the potential first wave of approvals in early January. On or prior to January 10th, 2024, we are likely to see approval of some, if not all, of these proposals, and while the price impact on Bitcoin remains to be seen, this will add even more legitimacy to this asset class. Over the past decade, Bitcoin has outperformed all other asset classes by at least a factor of 10, with an annualized return of 230%. That's all for this episode. Thanks for listening, and until next time, stay humble, stack sats, and keep upgrading.